What happened was that I examined what was happening when I was paying with my credit card abroad, and I was surprised, indeed shocked, to see that the foreign exchange mechanism behind those purchases would routinely add 5 to 6 to 7% on top of my purchases. 22.2 billion Hong Kong dollars. That's for 3 months alone. And that's how much Hong Kong people have spent on their cards when abroad. It doesn't include the cash element. But I think there is a very important play here for collaboration. So in my discussions with the car schemes to date, we've come to a very positive conclusion. Now, the traditional revenue model for card schemes and issuing banks is that they make a revenue from the money they take from the merchant for providing that service. What service? A reliable, robust, dependable payment scheme. It's a very good service. I would like to use my card more often when I go abroad. I don't like carrying cash. However, the FX element hinders me from doing that. Now imagine a post-Valoot world where I, as a quasi-consumer champion, I assure you, the consumer, of fairness and transparency and savings when you use your card abroad. What that results in is a dramatic increase in credit card usage. So if I move cash spend to card spend, everyone benefits. They make money from the fees when your card gets swiped abroad, and that is part and parcel of merchant acceptance of, let's say, Visa or MasterCard or Amex. I think they're entitled to that money. However, I don't think that the foreign exchange revenue stream sits very well within that domain. And so I'm all for people using their card abroad, and that drives revenue for the card issuing banks. However, I think that Valoot is definitely a better opportunity to make people comfortable about foreign exchange. I'm giving them the opportunity to make around 1% on foreign card transactions. And that's something that no one really gives them at this point in time, especially not when coupled with savings for the consumer and transparency for everyone. Because my model has at its core the consumer and the merchant. And these two parties have previously been ignored, which is somewhat ridiculous because they're the ones that are the most important to the entire transaction. There's two things. There's the comfort that comes from the transparency that Valoot gives you. Because right there at point of purchase, there's going to be a Valoot screen that shows you what that rate is and how we sourced it. And we're not sourcing it from individual banks, so it's not a bank rate. In fact, we use liquidity providers and FX providers to get us the mid-market rate at that point in time, also known as the Google rate. It's the rate that you would find out if you Googled Japanese yen to Hong Kong dollars on your phone just now. That's our starting point. On top of that, we put a very small service charge, maximum 2%, and that's the limit. Now, it's an option. It's a choice for the consumer. We don't automatically convert it. We don't hide anything. And at that point, it's a consumer choice. Now, I can't guarantee how much exactly you'll save, but I can tell you pretty much with 100% certainty that I will save you money. Merchants have spent a lot of time and a lot of effort in developing pretty much their own unique point of sale solutions. So if you go into a merchant that sells bags of rice, they'll have a very different setup to someone who sells leather goods. We work with what they have, and we make sure that the whole process is seamless.